has been with Aditya Birla Sun Life AMC since October 2005. He has over 30 years of experience in fund and investment management, and he's currently overseeing over rupees 3 lakh crore of assets under management. A qualified CFA from Hyderabad, he manages funds such as Aditya Birla Sun Life Frontline Equity, Aditya Birla Sun Life Mid-Cap Fund, and Aditya Birla Sun Life Focused Equity. With his vast experience in the mutual fund industry, Mr. Patil brings a wealth of knowledge to our discussion today. Next, I'd like to call upon Dr. V.K. Vijayakumar, Chief Investment Strategist at Geojit. Dr. Vijayakumar is a highly respected figure in academic circles associated with Geojit since 2010. He was formerly the head of economics department at Sri Krishna College, Guruvayur. He has authored numerous books on economics and written articles for leading financial newspapers like the Economic Times, the Hindu Business Line, Money Control, Mint, etc., apart from Malayalam publications and television channels. Dr. Vijayakumar's keen analysis of the market and the economy is highly respected in the investment community. Thank you for joining us. I'd like to invite Mr. Pawan Parakh, Fund Manager, Portfolio Management Services, Geojit. Mr. Parakh is an accomplished chartered accountant and CFA, bringing with him close to 2 decades of extensive experience in the equity market. His analytical approach and marketing insights will undoubtedly enrich the discussion today, offering valuable perspectives on the current investment landscape. With our esteemed panel now assembled, I'm pleased to introduce to you our moderator for the session, Mr. Amit Vyas, Head of Products, Private Wealth Services. Mr. Vyas, the floor is all yours.
Thank you. Welcome, everyone. Let's straight away jump to the exciting session. I'm personally very excited about this. So I will maybe go around the table first, and my first question would be obviously high level. How would you describe, as Satish sir said, Nirmala Sitharaman's 7th and Modi 3.0's first budget? Let's start with you, Mahesh.
Hello. Yeah. Good evening, everyone. So I think getting into this budget, right, if you look at, I think, we had an election result outcome, right, which was not as per expectations. Okay, we saw the current, the ruling party, right, they didn't come with a clear majority, right? So, and there was a certain message which was there in the elections, and one thought that this budget, okay, would be an occasion, okay, where they would probably do a bit different what they had done in the previous budgets. If you look at the earlier budgets, the focus has been purely in terms of trying to build the India's foundation, build the investments. Okay, was a big focus. We have seen investments to GDP steadily increase in the last 4 years, 5 years. And also there are state elections now coming in Maharashtra and other places, okay, where also the current is going to be a tough contest. So I think the expectation was that it could be a slightly populist budget. Okay, you could see some social welfare schemes. Rural economy also was something which was going through some of a pain, right? If you look at post-COVID, the recovery in the rural India has been slow, again, because of high inflation. And one would have thought that, again, looking at the election mandate, okay, that's a section probably which was not so happy. There would be something for that. But if you look at the finance minister budget, to sum it up, I would say that they have still remained focused on their path in terms of trying to go in for fiscal consolidation. by which I mean that trying to bring down the fiscal deficit. And so even in this year, right, the fiscal deficit target which was set in the interim budget, right, of 5.1%, they've actually further improved that, or targeting to improve that to 4.9%. And this year there was extra kind of a cushion for the government because they had got a large dividend from the RBI, around 2.3 lakh crores, which is almost 1.3 lakh crores more than what normally would have got. So there was a cushion, and how they would spend that, most of that was used to actually bring down the fiscal deficit. So it's a budget clearly going towards the path of fiscal consolidation. They've also said that in the next year, the fiscal deficit target will be 4.5%. And that, in that sense, it is trying to ensure that there's a macro stability which is there. I think India, despite the challenges during the COVID, where the government had to come in and expand the economy, right, expand the fiscal deficit to stimulate, but they have chosen, right, to from short-term gains to really look at a long-term and build a strong foundation for India, get macro stability. And at the same time, also they have also tried to address some of the other issues like in terms of employment. Right, so we have seen that India is the, largest people contributing to the working age thing across the world, and it's important that we find gainful employment over there. So the focus was for the first time in terms of how do you create employment. There were certain schemes which were launched to incentivize new employees when they're employing new employees to make some contribution from the government to the provident fund, okay, which was there on skill developments, because while we want to make India as a large manufacturing base, and that's been the thrust of this government, that you want to make India as a large manufacturing superhouse, because there's a big opportunity now after China, right? Our global companies, our MNCs are looking at diversifying the supply chain. So the biggest challenge there is that one is means capital, okay, other issues they have been resolved, logistics, but skilled manpower, right? Because we don't have there's a shortage of skilled manpower. In fact, I've been traveling and meeting companies, and especially in the MSME sector, small. One of the challenges is to get the skilled manpower, and that's an area they have tried to also address this time around with the skill development program. They have a large budget over there to provide skills, okay, for various areas, whether it's in the especially in the construction sector, right? For example. So that's again, I think it's slightly, I would say in the Sun's trying to focus on that area. And to some extent, I think for the first time, we've seen some shift towards trying to stimulate consumption, not in a big way directly, but some relief on the tax side, especially on the urban. So I think urban consumption is where I think the budget probably helps a bit. So I would say that to sum it up, steadying on the path of fiscal consolidation, less profit. And also I would have to simplify the tax structure. While many people have been upset in terms of so many changes which have happened on various asset classes, but the objective of the government is to try to simplify, right, the tax structure and try to rationalize, okay, into various asset classes into really kind of buckets. One is listed equities and non-listed equities. I think that's the path, I think, which the government is trying to, the budget is showing us.
So very well summed up, Mahesh. If I were to ask you, if you were to maybe rank the budget on a scale of 1 to 10, what would you give, what would be your call on that one?
I think, trying to really look at the overall longer term picture, I would not look at really from a short term perspective. I think the fact that we are, this country is heading towards trying to be one of the largest economies, second largest economy, right, in the next 25 years. And also possibly moving towards a developed nation. I think in that sense, I think trying to focus on macro stability, I would say that I would give it, say, around 7 out of 10. Probably I would have liked it would have been higher if they had also tried to give some stimulus to the economy, right, on the consumption side, because that's an area which is slightly weak. If you look at in the economy, the recovery has been a bit K-shaped, right? The upper section of the economy or the privileged class, they have done well, but the bottom of the pyramid is still recovering. And some amount of, I think, boost would have helped. And again, from a capital markets perspective, increase in the capital gains tax. Yes. I don't think it was necessary at this point in time, okay, when we're just trying to actually come back and build the positive sentiments in the economy. But I think overall, I think it's a good budget, I would say.
Sure, great. So 7 on 10. We'll move to Dr. VK. Sir, would you like to describe your thoughts on the budget?
I think Business Standard described this budget the best in 3 words. They said this budget is political but prudent. These are the 3 words, political but prudent. We know the political dimension of this budget. Under the circumstances of coalition politics, you have to be politically correct also. Before the elections, the Prime Minister said that the next budget would be transformational. Perhaps he was a bit confident, overconfident about the outcome of the elections, and the expectations was that the BJP will get a majority on its own. But this expectation of a transformational budget has not materialized because under political compulsions of a coalition government, you cannot have big bang reforms. Sure. So the big bang reforms are not there. But under the circumstances, they have done well. I agree with Mahesh that the overarching theme of this budget is fiscal consolidation. Fiscal consolidation is necessary not only to have financial stability. Growth with financial stability is important, and that is one Achilles heel of the Indian macros is that our debt to GDP is 81%, higher than that of most emerging markets. Right. That is one point that is standing in the way of our credit rating getting improved also. So it is important that we have to get our fiscal deficit under control. And that is why the finance minister has done better than the 5.1% fiscal deficit target which was there in the interim budget vote on account. So that is the overarching theme, and that is the very positive development also. And also I would say a major challenge that we are facing now is that the consumption is not picking up as much as we wanted to pick up. Last year we had GDP growth of 8.2%, but the big paradox is that in spite of this 8.2% GDP growth, consumption is struggling at 4%. Right? Unless consumption picks up, we cannot sustain the growth at very high level. Sure. What we are witnessing now is that class consumption is doing well, but mass consumption is struggling. It is evident from the stock prices also. Absolutely. For FMCG companies, the share prices have been struggling, whereas for companies at the top of the pyramid, the share prices are shooting through the roof. Therefore, in order to stimulate consumption, the RBI, the MPC also have to cut interest rates. But then the RBI governor, in one of the recent interviews that he gave to a news channel, indirectly conveyed the message that we would be looking for fiscal consolidation in the budget before cutting rates. So cutting rates is the best way to stimulate consumption. And that way also, the message from the government is very clear. Sure. We are getting fiscally prudent, therefore the monetary authorities may follow suit. Great. That way the budget is extremely desirable. Yeah.
So how much marks would you give to this budget then?
Well, these days I've been in the academic field and we have stopped the practice of giving marks. It is more grading. So I will go by the present system of grading and will give an A grade to this budget.
So, okay, so I'll do the conversion for audience. A grade for him is 7.5. Is that okay?
That's okay. That's
okay,
fine, yes.
Great. Let's jump to Pawan then. Pawan, would you like to share your thoughts?
Yeah, so before starting, I must say I agree with both of my senior colleagues as to what they have said. I just want to highlight one thing is that, in this budget, they very smartly mixed up politics and economics. So if you see one of the few things where they got caught at the wrong end in this election campaign, obviously, is employment, right? And they tried to address it upfront. I must tell you, apart from employment, all of those 9 priorities that Ms. Nirmala Sitharaman actually highlighted, a lot of this are not a one-year phenomena, right? So I think you should look at budget as a statement of intent. And very clearly in this budget, they've shown this statement of intent that they want to address this employment issue in the country. And I think it will take multiple budgets for India to move in the right direction. If you look at the NDA Part 2, the last 5 years, what they tried to do is that, they tried to revive manufacturing, Capex cycle, defense, railways, etc., etc. So they rolled out this PLI scheme. And the entire objective of this PLI scheme was to create large champions, Right now, India is a large diversified economy. I think after a long time, India has got a large policy initiative right, while a lot of work is still to be done on the PLI side, but I think they've got it largely right. Now, it's really important that India needs a very large MSME and SME ecosystem. So apart from employment, employment and skilling, what they also did in this budget is they started making some initiatives on the SME side also, right? So once again, as a statement of intent, the way I would read it is that in the first innings of the NDA 3.0, they've laid out the framework for the next 5 years, right? And the third point that I really want to highlight is they want to increase the formalization of the economy. So some of the announcement that they made on the land side, digitization of land records, etc., I think these are the key 3 pillars which I would actually see as a very strong statement of intent on which they would work getting next 5 years. Otherwise, as far as this budget is concerned, I think, I going into the budget, I think I thought it would be more of the same, and essentially on the infra side and many other things, it was more of the same. And anyways, in next 6 months, we're going to have another budget again. Right? So I would say they've done a very fine balance of mixing politics and economics. And in fact, just to add one last point, very, very, very evidently they had mentioned Bihar and Andhra in the budget also, right? But all of those spend for Bihar and Andhra was also in infrastructure. Right. So they did not go loose on spending unwisely anywhere in those states, right? So I think they've done a very fine balance there.
Sure. So would you like to give more than 7.5 here?
Yeah, honestly, I don't have a number, but obviously it is 7, 8, something like that sort. It is an A-grade budget.
Okay,
certainly
great.
An A-grade budget.
Great. So what I pick up from what Mahesh said and possibly Dr. VK mentioned are 2 important things. One is obviously the total expenditure to the GDP. That number has not been elevated. That's still 3.6. Plus the glide path or the guidance which has been given on fiscal deficit from 5.9 obviously coming down to 4.5. If we double click on these 2 things, do you think my number could have been elevated, or is the peak government capex behind us? Because what we are also picking is there is no contribution coming from the private corporates. And the government has been signaling constantly trying to push the corporates to participate now. So is the government capex behind us? And if it is this the right time to do that?
Yeah, so if you look at in the last 5 years, right, this government capex to GDP ratio has gone up significantly, right? And they have done that initially, I think during COVID also. I think the push from the government really required in terms of making the investment. Government was doing the heavy lifting at that point in time because private sector was not really investing, and they have done that to a large extent, and that's been pushed up. Now incrementally from here, I think in this budget also we have seen that that ratio has gone up a bit, but not meaningfully, right, to that extent. And again, if you are also trying to consolidate, right, bring down the fiscal deficit, you will have less avenues. And I think in the past, the government, if you look at the tax inflows, right, tax to GDP ratio has also been going up. Even this year also, if you look at the tax collections are good. So I think there will be some room, I think, which is there, where you will get positively. The overall fiscal math is fairly conservative. So I think they could, you could see capex to GDP ratio, government investments could pick up. But I think more if you look at the allocation, see, finally, if you will all make a big hue and cry about the central government capex. But that's a very small percentage. There's 15% of the total fixed capital formation. There are a lot of investment which happen at the state level. In fact, it's much bigger. And then there is private capex which is there. And then there is the household capex, which comes in the form of your houses, buying a house. That's also part of the overall. So I think the allocation to the states, if you look at in the budget, I think that number has gone up because the larger execution happens at the state level, how the state execute. And I think that's where I think they have tried to increase it because that spending is much faster level. So I would say that, clearly I think the government side overall increasing the intensity, right, on the investment side, I think will probably slow down from here. And now it's time for the private sector to pick up. And the government has done its bit in terms of trying to incentivize the private sector. We've seen the PLI schemes, okay, which have come in to really come in large Capex. There are 13 industries where the production linked incentive scheme has been coming up. Now the government is also looking at not only production link, but to generate employment. They are coming out with schemes where it is linked to employment. I mean, you have to create so much amount of employment. There's no point just setting up a new high-tech plant, but it doesn't employ too many people because you also create employment over there. So, I think the private balance sheets are in good shape. Right? A lot of corporates in the last 3-4 years, if you look at the corporate debt to debt equity ratio has come down significantly. So I think now it's the private sector, I think, to do the heavy lifting. And I think post now elections, I think that was one of the things which corporates were looking at to get political stability. I think you should see that now to contribute. And there is off balance sheet also where the government is trying to support the investments, right? So there are these institutions which are there, right? The National Infrastructure Fund which is there, where they can lever further, right? To raise money, okay, through corporate, through the bond issuances, okay, which can invest into the investment side. So these are the other avenues, okay, which will continue to sustain the investments in the economy, not necessarily from the central budget.
Sure. Dr. VK, what do you think? 4.9, 4.5. How achievable is this target for this government? Do you think they have the execution prowess to achieve that 4.5 number?
Well, the finance minister's target is 4.9% this year and below 4.5% next year. She was emphasizing below 4.5%, not 4.5. The fiscal glide path has been 4.5. Now they are targeting below 4.5. That is certainly achievable given the growth momentum in the economy and the tax buoyancy in the economy. That is certainly achievable. And also, as my friend mentioned, even when the money is being spent on the coalition partners in Andhra Pradesh and Bihar, the money is being spent on infrastructure and not on wasteful consumption, populist programs. That is not there. And a very important point that I would like to add here in complement to what he suggested is this employment part. An innovative program in this budget, a proposal in the budget is the internship which the government has declared, and the government expects the top 500 companies to participate in that, because the corporates have always been complaining about the non-employability of the human resources that we are getting. We are getting people, we are producing millions of graduates, but they are not employable. So the government has thrown the ball into their court and they said, we are prepared to pay them the apprenticeship of, let us say, 5,000 rupees per month, plus one additional expenditure of 6,000 rupees. And the cost of internship has to be borne by the companies, and 10% of the cost can be borne from the CSR of companies. So companies have a responsibility. I hope it is the practical side may be a little bit problematic because it has to be done without any bureaucratic intervention. So if it is done successfully and efficiently, it is well executed, we will be addressing this major challenge of unemployment that we are having now.
Sure. Pawan, my question to you is, FM has not set any target for disinvestment or asset monetization. How should the market perceive this?
So actually, this reminds me that Piyush Goyal had, once made a statement that, we are here for wealth creation, right? So, and after Mr. Modi made that statement in Parliament, I think that was just a turning point perhaps, but for the kind of wealth creation that's happened in the PSU space and kind of fiscal consolidation that they can achieve without disinvestment itself, I think they've tried to strike a very fine balance. And honestly speaking, some of the assets that they've listed down to sell also are not so very easy to sell. There are some, so Concor is a classic example. I mean, they've been talking about Concor for the last 2 years, but then there are local land level issues. There are, being a PSU company, they enjoy some priorities, they need to address all of that. So I don't think, they would want to run behind disinvestment at this point in time when anyways their mathematics is right between fiscal deficit and growth.
Sure, great. My next question to you, Mahesh, is the Indian markets got re-rated when there was a corporate tax restructuring. Now, what we have seen essentially is coming to a topic which is very close to my heart, and I'm possibly maybe voicing out our clients here. Why this taxation change on the duration and the long-term and short-term capital gain? And what are your thoughts on the possible trajectory of the market through this change?
Yeah, so I think you're right. I think if you look at the government intention, I mean, they have said is that they want to rationalize a lot of these different asset classes which are there, right? Create only two asset classes. One is listed equities and others, right? And that's what's one of the efforts, okay, which they are trying to do in this budget. And also the thought process is that the taxes, okay, there's a differential taxes across asset classes, and rightfully so. I mean, certain asset classes you want to promote because that's a long-term savings which is there, right? And you want to channelize money into those asset classes. But the thought process is to rationalize, okay, the taxes and try to give uniformity across asset classes. So that was one of the intention, and we've seen some steps being taken in that direction in this budget. So I think clearly, I think, and also I think they've seen that while capital gains tax has been increased, and the belief is that capital gains tax, okay, it's only the top. I mean, in a way, the government is trying to take some income, okay, from the rich and trying to distribute that, and they're trying to bring this sort of inequality that has been a kind of a blame which has been given to the government, right, from the opposition parties in the last few years. We've seen the inequality has gone up. So to that extent, I think to address that and to show that, I think they have increased the capital gains tax in that sense. But I would say that from an investor perspective, I think while we'll enjoy the benefits of, we had a period when the taxes were zero on equities, right, when that first happened, and then it was increased to around 10%, now to 12.5%. So while we'll be unhappy with that, but if you look at in other developed markets, other markets also, there is enough. The tax on, say, equities, for example, is much higher. And when you're investing, I think when you're looking at any asset, you look at the potential returns for that. You don't look at the tax what you have to pay and then take a decision. So I think the way the budget and everything is coming in and way we are shaping up the economy, I think we are in a very sound footing. Indian economy is likely to grow at a steady pace, I think, for a long period of time. And if that happens, you will see corporate India will do well. Okay, wealth creation will happen. Say for equities, for example, if you look at, you will see corporate earnings growth will continue to grow. And I think that if that happens, if you're able to make money in a particular asset class, then you don't mind paying slightly higher tax. First is to make money, right? Then only you think about taxes. So I think that opportunity is still there. So I would say that, and in fact, a lot of other asset classes, like for example, if you look at REITs, InvITs, for example. So everything was earlier getting, other than equities, right? Everything was getting classified the same tax rate as what is there on the fixed income. So now REITs and InvITs are also interesting products, okay, which are there because as an investor, you also want to diversify, right, from equities into other asset classes which are high yielding. So there, the taxes have actually come down now, right? So they will be taxed at around 12.5%. So gold again, like for example, right, which is again an asset class which I think it's very popular, right? So gold ETFs and all these things were earlier, okay, taxed at a much marginal tax rate. Now, okay, they will tax at a similar rate, right? So all long-term capital gains tax, they only borrow two buckets. One is 12.5%, and other one is in the marginal tax rate. So in that sense, they are trying to simplify and make it. There are other implications on real estate. We can talk about that later. Again, how it is impacting where the indexation has come down. But that's the whole kind of a way the government wants to move forward. And in that process, I think you will see some cases, okay, where their taxes have moved up and see. But I think in the end, I think it is. It's if the returns are there, economy is doing well. I think that should be fine. I think.
Great. Okay, Dr. VK, we read a week back a lot of money is moving from banks to equity markets. That was one of the comment a week back. Do you think that is also a key reason for the government to make equity a little less attractive?
I don't know whether that was the reason, but then in the economic survey, there is a sentence in which they are expressed concern about elevated valuations in the equity market. And
especially the FNO.
About the elevated valuations in the market as a whole, not just in the FNO. FNO, of course, the government is trying to restrain.
Talking about market cap, okay, as a percent of GDP.
Yes,
right?
Market cap as a percentage of
this
GDP
year.
is 139, 140 now. The long-term average is 85. And the PE ratio is around 22,
Right.
1 year forward earnings. And the price to book, the historical average, I think, has been around 3.5, now it is 3.9. So going by these historical parameters, valuations are high. The valuations are excessive in the broader market, in the mid and small cap segments. But in the large cap space, I would say the valuations are going by the potential that India has. There is no doubt that India will be the fastest growing large economy in the world for many years to come. Therefore, a higher valuation than the historical valuation parameters are justified now. But then if you go by all this, I was remembering, I was thinking about that when somebody talked about this Buffett ratio being 140. It was around 135 in early 2008, which was followed by the crash. There are no possibilities of a major crash. Of course, there can be unknown factors. But then it is a fact that valuations are a little bit high. The RBI has that concern, even though they didn't specifically mention it. The economic survey speaks about that. And in the post-budget analysis, some officials of the finance ministry also alluded to that. So maybe you are right, the government wants to control the bull which is on steroids right now.
Sure. Okay. So, Pawan, let's come to the more interesting session or part of the session, so to say. What we would like to know is, are there any clear set of winners now that the budget is out? Are there any clear set of winners from a sector perspective in the market? What is the market setup now?
I think from a market perspective, I think it's more of the same. The only thing, so essentially, if you look at last 3-4 years, all the Capex related themes, all manufacturing related themes, they did well. I think that is here to continue because the focus on renewables, focus on digitization, focus on new age economy. I don't think they have lifted the pedal on that. So I think it is more of the same. One new angle that I would actually want to explore over the next 2 quarters is that as and when, so this time around, if monsoons are fine, agri incomes are fine, inflation, if it's moderating, will that be good enough to revive consumption? And if that is the case, I think that is a huge basket which hasn't done well. And there's a huge sub-sectors within the consumption sector which are very attractively valued there.
Sure.
Right? Apart from that, if you see, affordable housing has got a clear focus there. A lot of the stocks in that sector haven't done well. In the real estate space, the entire focus was on premium and super premium housing. Now, at least affordable housing is doing well. So both on the housing side and on the housing finance side, wherein stocks haven't done well, those are again new set of winners that one should be looking at from a 1, 2, 3 year perspective.
Great. Same question to you, Mahesh. What do you think? Are there any clear set of winners? Plus, maybe what you can also touch upon is essentially, as Pawan alluded to, we have seen last 1.5 years especially, the under-owned part of the market actually really did really well, right? Our entire PSU basket, infra, ancillary, defense, these capital good, this sector has actually done really, really well. And if I were to relate, we have to go back to those 2007-8 days. What is your take on these sectors? Is there a sector rotation around the corner, or do you think these sectors have a structural leg or a story going forward as well?
Yeah, so I think, you're right. I think it's been a few sectors, right? Especially the investment-led. I think that's been the big theme for the last year, right? We had industrials, capital goods, PSUs, right? The power sector, for example, real estate sector, right? Do phenomenally well. I mean, there was a big divergence over that. I think going forward from here, I think we think that it's time to, while the outlook on some of these sectors is still good, I think in India, you will see Capex, kind of picking up. Infrastructure, investments in infrastructure will continue. Power sector, for example, is a sector which is again now come back strong because we have realized that we don't have enough power, right? Because we all move towards renewables in a big way. But the core, right, for the base load, you still require thermal power. And India, power demand is still growing up. Suddenly, government has woken up and they have said, besides your solar and besides your wind power, now we also need to increase our thermal capacity. So suddenly, power sector is seeing a huge capex, not only India, but even globally, right? So that's driving a huge demand for power equipments, which is there structural. But some of these stocks have run up quite a bit. Railways, defense, if you look at, right? Again, big capex announcement in the previous two budget. This budget, there is not much of an increase which is there because now they need to execute that. But I would say that going forward from here, I think you have to look at other sectors, which can, as you rightly said, there could be sector rotation, which is there. And we believe that, consumption and consumption-oriented sectors, right, which have underperformed. And rightly so, I think the demand was weak, especially consumer discretionary, right, because that has seen quite a slowdown, and we've seen now a revival of that a bit in consumer discretionary. And this is if India's per capita GDP is going to go up, currently it is at $2,500, right? And with the economy, I think that will go up steadily, whatever to $10,000, in the next 10 years. Then demand for discretionary consumption, right? Besides your basic consumption, you will start to spend more over there. And that's a more structural theme, which was impacted last year because the inflation was higher, disposable income had come down. And if you look at this budget, is one broader theme is that it is disinflationary, right? Because you're trying to bring another fiscal deficit. Now the RBI has room, right, to look at because now the finance minister has done his part. So now RBI will have room to cut interest rates. Right. Because already inflation, core inflation is now coming down. It's at around 3.5%. So you would see rate cuts down the line, say another 6 months or 9 months down the line. And that would mean that when rates go down, automatically that will spur discretionary consumption because rates go down when you want to buy a house, you want to buy a car. So in that sense, I would say that consumption should see this thing. And again, rural side of the economy also, which has been kind of pained for the last 2 years because of monsoons to some extent, but also because rural wages, inflation was very high, right? So which was hurting the real wages in the rural economy. I think with inflation under control, which this budget tries to drive, I think you will see rural economy also start to recover from here. So I would really look at some of the other consumption, discretionary consumption-oriented sectors, which could do well. And apart from that, I think housing and real estate, I think will continue to do well. I think if interest rates come down, despite high interest rates, we have seen the demand for housing been very, very strong because we are coming in a cycle, right, where we have seen almost prior to this, around 8-10 years, the cycle went through a very, very big downturn. And there is a genuine demand for housing in India at a particular price, right? So I think that's another sector, I think, which, especially housing, and I would say not so much real estate, but housing-related stocks, right? Because now, once you have started initially housing and you need to refurb, building materials, right? That's where you need to spend. I think that's where I think you will see the demand start to pick up. And apart from that, I would say other sectors, like, for example, digital IT, right? Again, IT is a sector which has been a laggard in the last 1.5 years because of the slowdown in the US. We have seen discretionary spend in IT slow down. But I think it is now kind of bottoming out. Sure. And we don't expect US economy, right, globally to go into a recession, which was kind of a concern earlier. It will be a soft landing over there. And India is very well placed really to cater to the needs of the global IT industry. And spends in IT are only going to go up because the way technology is now pervasive across all industries, right? Any industry, if you look at it, if you really want to be relevant and competitive, it's on the front end. There's a lot of investment which is going to happen over there. So we think that the IT sector, after going through the slowdown, I think you could see now there are early signs of things kind of bottoming out. So that could be, again, a good sector which can be a more defensive in that sense, not necessarily in the domestic economy. So I think that shift, from some of these cyclical sectors and the investment sectors, I think, to consumption and some defensives is what I think one we would look at and we think that should do well over here.
Sure, sure. Dr. VK, you touched upon the valuations being at elevated level and the government is kind of worried about it, and you touched based on the market cap to GDP ratio also in general. But what we essentially have experienced is the rear view is really, really very good in equity as an asset class. Investors have made decent 15 to 25% kind of money in the last 3 years. In some cases, maybe more than that. What do you think fundamentally is the reason that the markets are not correcting or not giving a chance to? And what we read essentially is the mutual fund industry is sitting at a cash of almost 2 to 3 lakh crore. Plus we have 21,000 crore of SIP input value coming in. And what is essentially coming out is equity has by design now a go-to asset class. The relative attractiveness of equity as an asset class versus debt. Nobody's talking about debt these days. So what is the fundamental thesis? Will this market kind of give us corrections to enter in? Will this continue to go up? What is your sense around this?
Well, we don't get corrections when we want the corrections to happen. There's a famous saying that more money is lost in waiting for corrections than in corrections themselves. Therefore, we have to be concerned about valuations because if you look at the big corrections that has happened in the market, corrections are triggered by not the known unknowns, but the unknown unknowns. In early 2020, nobody thought that a pandemic is going to paralyze economic life all over the world. Even nobody thought a war will happen in Europe. All this happened, right? So unknowns can suddenly emerge out of the blue and impact the market. The reason why I am a little bit concerned about valuations is that when the valuations are very high, when you are flying high, the drop also can be a little bit painful. That is why I'm a little bit concerned about the valuations, not in the large cap space, but mainly in the mid and small cap phase where valuations are becoming unjustified. But then the reason why we are not getting correction is that every time the market is dipping, retail investors who are calling the shots now are just buying as if there is no tomorrow. That happened on the day, on June 4th, when the election results came. We were surprised, even the seasoned investors in the market and experts were surprised by the ferocity of the retail buying. Sure. And again, on the budget day, after the correction, again, there is. And what happened today, for instance? Yesterday, NASDAQ corrected by 3.64%. 3.64% correction in
Absolutely.
NASDAQ is no issue at all, even though the market opened gap down. I think it closed almost flat today with only a minor cut. So this explosion in the retail investor demat accounts, it was around 4 crores. In April 2020, now it is north of 16 crore. And the majority of these newbies in the market, they have never seen a bear market. So one guy rang me up and said, when the market corrected by 1%, the market crashed today. So 1% correction is a crash for him. So these guys have not seen a correction in the market, a big sharp correction in the market or a prolonged stagnation in the market.
I would say in the bull market, big bull market which was there, right, from 2003 to 2008, in that period, I remember there have been at least 5 instances, 4, 5, when the market corrected more than 20%.
Yes.
Right, in that bull market. So I think corrections in a bull market of 20% or this thing is still not extraordinary. I mean, you can expect, but we haven't seen that, I think.
It is good, actually. It makes the market more healthy.
Yeah, definitely.
Yes, you're right. I think there were 5 corrections of more than 10% and 3 corrections of more than 20%. So, and what did we get from 3,200 Sensex in May 2003? We ended up with 21,000 in early 2008 with all these corrections. But then correction has been conspicuous by its absence after the COVID crash of March 2020. And the big game changer has been the emergence of retail investors. It is good that retail investors have become a force to reckon with, and we are no longer dependent upon foreign portfolio investors, because FPI money is always hot money. They will be driven by large number of extraneous factors. When the US bond yield shoots up, they will be selling in India, irrespective of whether India is doing well, whether GDP is growing at 8%, corporate profitability is growing at 24%. They are not bothered about that, because 4%, 4.5% return on 10-year US bond yield is very attractive return for a foreign institutional investor. But Indian investors are not bothered about the US bond yields. They want the money to be invested in India, and we should be encouraging that. But then my only request is particularly to the newbie investors who have entered the market is not to be blindly optimistic about the market, because the market can surprise. Always it can surprise.
Right.
Whether it is a bull market or a bear market, we know it can always surprise on the upside. It can surprise on the downside also. So we have to be at this juncture when the Nifty is around 24,400 and the valuations are north of 22. We have to be at least a little bit modest in our expectations in the short run. If you have a long-term horizon, of course, there is a consensus that India will be an $8 trillion economy in 2032 with a market cap of perhaps $10 trillion. So a lot of wealth creation is going to happen, and we all agree with that. But then the journey is not going to be very smooth.
Right.
The journey will be always a little bit of a roller coaster ride.
Yeah, absolutely. But we are a serious buy on dip market, but the markets are not giving us opportunity to come in at this point of time. We will take the final question with you before we open the floor for questions from our esteemed clients. Again, just the extension of what we are talking here, Pawan, SME IPOs. That space has been giving 80 to 90% CAGR returns, again, unstoppable in the last 3 years. Then you have this small micro cap, then you have this small cap, then you have the mid cap. Obviously, what we are picking over the last 6 months to 1 year's time is large caps are relatively attractive vis-a-vis to this entire space. But that space again continues to perform. So when does the music stop? What are the triggers which we or which you as a fund manager or capital allocator believe that these are the triggers which you should normally as a framework can be used at a higher level, which kind of signals that the music may stop soon? I know I'm pushing you to a corner, but in the maybe for the larger crowd here.
Honestly speaking, the smartest of the smartest guys on the street cannot judge with reasonable level of accuracy as to when the music is going to stop. The only thing that you can do at this point is exercise restraint. See, I'd just like to highlight a couple of things. In the last 5 years, there has been a big sector rotation. So we've seen that PSU banks have done so well, and we see that they are 10x from their bottom or 8x from their bottom. But we also have to understand that there has been a substantial increase in profits, and they were trading at 0.2, 0.3 times price to book. And as things stand today, they are anywhere between 0.9 to 1.3 price to book. Okay, so the reference point is also very important. Mahesh referred to power stocks. A lot of these power stocks were trading at less than 1 time price to book. Okay, so in terms of when does a party stop, essentially what you should be looking at is that is there a adequate balance between growth and valuations. So I can, without naming any stock, there are several large cap stocks. I mean, I'm referring to stocks with more than 1 lakh crore market cap, wherein the entire growth is only driven by some investor frenzy, because there is no institutional holding there. The promoter holding is very high, and it's largely a retail driven stock, and either the company is growing just because there is a assured business from government, or maybe just because the cycle is good, but the inherent merits of the business doesn't justify that kind of a growth, right? The only thing that investors should do is that they should exercise restraint into investing into those names. Otherwise, I think the only big mantra of making money in the market is that you have to participate in the upturn and downturn. I don't think anybody in this market can say that, I'll participate in the upturn, I'll exit the market when the music goes off, and then come back again. I think you'll have to ride the market both on the up and down, and that is how eventual wealth creation will happen over the next 5-10 years.
I think many stocks, especially in these categories you talked about, right? SME and this thing, the liquidity is very, very, see, I mean, at this point in time, okay, when money flow is there and liquidity is not there, I think prices can go up. But we see that reverse can also be equally true, right? We've seen in the earlier cycles during the dot-com crisis, right? We saw vertical rally, and then when there's a selling, I think there are no buyers at that point in time, right? You think you can sell probably 10% lower, 20% lower, but you can't do that practically.
I remember the Unitech and the DLF times when if you as an investor never owned Unitech and DLF, you were not a great investor, right?
Right.
I mean, Unitech at 550, DLF at 1250, and Ajmera Realties and...
So there are pockets where there is clearly over-exuberance, which is you have to be careful. I'm not saying the broader market is... See, the good thing is that we are not peak of the economic cycle. Then you have to be worried really, because you are the peak of the economic cycle or the peak of the valuation cycle also, then clearly there is only way down from here, right? What will happen is that even in the broader market, as we talked about, valuations are slightly nifty, slightly higher. It might consolidate a bit for some time, but earnings will catch up, right? So the earnings growth trajectory is still fairly strong, and I think it will continue. If the economy continues to do well, a lot of good things have happened. Okay, we talked about that. So in that scenario, I think broader market, as I said, nifty, large cap names, looks fairly steady, right? They are not overtly, I think there's a premium always which will be there. For good stocks, for good quality, where there is growth, they will always be at a premium. India will also continue to have that premium because India, amongst all the global markets, is growing at a faster clip. And obviously the profitability of corporate India is also now much better than what used to be like 5 years back. So that premium will repair. You will not get cheap. And that's people want, you will not get that. But you have to differentiate within that, right? Okay, where the quality is there and where the valuations are. At certain point in time, you have to say no, right? Like this is a time where we are in our portfolios also trying to reduce our risk. We are not reducing our equity exposure. Okay, we are not creating cash, big time cash, but we are shifting the portfolio a bit and trying to get into better quality stocks, reducing some of the stocks which have run up, right? We also participate in the market for momentum, right? Some of the trades which we do on the tail of our positions. We are trying to reduce that and take gains over there and put in stock where the margin of safety is better, because this is a time to protect your capital also, right? What gains you have, and also participate. So it's not, you don't want to be out of the market also, right? Because we don't know when the correction is going to happen, because for waiting for correction, people have missed out a lot of opportunity. You stay in the market, markets will, even if there's a correction, it will bounce back. I mean, pretty sure about that.
Yeah, we normally underestimate the resilience of our own market at times, which over a period of last 20 years, what I've experienced is the market always bounces back. The quality businesses always come back from a price action perspective.
I think just one thing that obviously we all know, but needs to be highlighted, that this time around when we entered the upcycle, with a very strong balance sheet. Yeah. As we discussed, corporate India went through very long period of corporate deleveraging. And even during the post-COVID liquidity gush, a lot of the Indian companies went ahead and raised fresh equity, which further strengthened their balance sheet, right? So when you enter a market from a position of strength, that is in itself a very strong ingredient of high valuations, honestly.
Completely agree. I just didn't touch upon one thing before I let you guys go, or maybe open the floor for questions, is we are slated for US elections in November. And it has become extremely interesting for what we have seen in the last 1 month. US elections are always, closely watched. They are known as the big daddy, right? So what is, Dr. VK, your view? Should we ideally watch that event? And if Trump comes and what we read is he's going to be transactory in nature and maybe look more inside than outside. What are your thoughts? As an investor, should we be worried, or is just one of the many events in the markets which continue to happen?
We should be concerned about that, and we should be watching that space very closely. Now, according to the indications coming from the US, the probability of Trump getting re-elected is very high, 57-58%. Therefore, that is a near possibility now. And if it happens, and if Trump walks the talk, he is very protectionist, and he has already gone on record saying that if there is a 100% import duty, on our products that we export, we will impose 100% import duty on your products. And I fear that is one major concern that I have, that towards the end of this year, perhaps even earlier than that, if the polls indicate a Trump comeback, well, it can ignite a global trade war. There can be a trade war between US and China. Recently, even European Union, which is not very aggressive, raised the import duty on certain categories of electric vehicle component imports from China to 38%, as high as 38%, from 12% to 38%. Trump can do much more than that, and China will certainly react very strongly. That can trigger, I'm not being too pessimistic, but then that is something on which we should be a little bit concerned. That is, in my opinion, the biggest threat to the international trade this year and going forward.
Sure. Mahesh, your thoughts around this one, if any?
No, I think I would agree, okay, that I think everyone is trying to be more protectionist, right, and to protect their economy, and US also with the Trump rhetoric, what it is there, okay, but I think sometimes there is a lot of rhetoric which is there, right, when actually somebody comes to power, they have to also balance things out. It's not always possible to do that, because how do you do that in US, right? I mean, you don't have the manpower. Even if you want to start manufacturing and this thing over there, there are no skills and manpower which is there, right? How do you do that? True. So while they would try to do that in terms of giving some protection in a few sectors, but I think India to some extent is still, I think we've seen that, right? Whereas some of the protection, okay, which I'll give one example, right? In the renewable side, in the solar, right? So US has put import duty on China. Right, on importing of solar panels. And India is actually beneficiary, because a lot of some of the Indian companies now, they are exporting there. They are not as competitive as China, right? Because we also import from China over here, right? And we also have good duty protection over here. But they are able to export to the US market, because US itself can't manufacture, right? That much. And there is also demand for renewable energy over there. So I think if India has been able to play its cards fairly well, right, in terms of managing and that's what this government has done. I mean, Mr. Modi, he is able to keep relations with US also, with Russia also. When the Russia-Ukraine crisis happened, we could still import crude from Russia, right, at a low rate. So I would say that there is going to be some volatility around that period, but I think sense will prevail. I don't see that should really derail, okay, the whole macro story for India. If at all there is a volatility during that period, I think that can be an opportunity. I don't see India is less dependent, right? Our growth is more like in US, in China, for example, right? The bulk of this thing growth happened because of the exports, what they did, right? India still, we are exports in a certain nation, like for an IT sector, for example, right? I mean, you can't, right? While there will be some kind of tariffs or whatever, okay, which could be there, or immigration laws could be much more stricter. But you can't substitute, because the spend on technology has to be there, and you can't have the IT manpower anywhere else in the world. And India is the only source where you can have a skilled manpower. So I think it should be less impacted, I would guess.
Great. With that, let's open the floor for questions. I would encourage if anyone wants to go ahead and ask. Yes, please.
This is regarding what could be possible. Like in certain sectors like defense, shipping, railways, mostly by the PSU companies, the floating stocks is very limited. In such a situation, what is the further scope of this, or what is the danger of this going ahead? More than that, suppose a disinvestment come in these sectors, what could be the possibilities? And also probably where you see India in 5 to 10 years in the current situation.
Well, these two sectors, railways and defense, has been stars during the last more than 2 years. They have done exceedingly well. There is no doubt that these two sectors have very bright prospects. But the problem is, all the good news is, in my opinion, already in the price. Already in the price. You refer to some shipping companies. There is a shipping company whose 90% of the equity is held by the government. So the floating stock, as you rightly said, is only 10%. And there are a lot of operators operating in that segment. And the volume, intraday speculators are there, volume is very high. And therefore, even though the prospects are good, well, the fundamentals do not justify the valuations right now. The problem with excessive valuations like this is, when you have some bad news, it was referred to, Mahesh referred to that. I remember in 2008 also, some of the stocks were in, which had run up too much too fast, were in down circuit for 5 days consecutively. When such stocks are in 5 days down circuit continuously, you can't sell and get out. Even if you are incurring a loss, if you want to sell and get out, you can't do that. That is why at this juncture in the market, you have to be more focused on quality rather than on prospects, let us say 5 years from now, 6 years from now. So in these segments which you suggested, one has to be a little bit concerned about the valuations.
Yeah,
in
so
my opinion, the fundamentals do not justify the current valuation.
Yeah, you're right, I think. So you were looking at some of the names, right? If you look at the price to book value, see, earnings is something which you can't, P multiples can be anything, right? When you're coming in from a low base. But price to book value is a good indicator. It's some indicator which gives how much extent the valuation is. So some of these sectors, like for example in the railways or defense, the price to book value has gone as around 15, 17, 18 times, right? Whereas if you look at on a comparable basis, like for example, even consumer company, which is supposed to be high quality companies, right? Where the price to book value, expensive name, they would be around 10 times. So clearly there is, market has gone ahead. While these are good sectors, the opportunity is good. Some of these sectors, while some of these companies are good, execution is very important to see, because some of these, like shipbuilding, for example, just to give, it takes almost like to build up a large fleet. This thing, it takes around 8 to 10 years, 7 to 8 years to build that. How they are going to execute that. Market is now discounting all those into the future, but execution and this thing is also important. And there are a lot of constraints, okay, which are there. So I would say that in some of these sectors, okay, one has to be this clearly there is overvaluation, okay, which is there, and one has to be careful. Outlook is good, okay, one is not saying that. So at a price correction, I think they can start looking at attractive. That's where you have to be careful. And some of these stocks are also, the free float is very, very less, right? And you might see, as you rightly said, the government might one day come in, okay, and offer, and once liquidity comes in, free float increases, okay, some of these overvaluations also gets normalized.
What about the possibility of danger of disinvestments in these sectors, especially PSU?
Could happen. I think government could.
Will it be good or bad for the market?
No, so good in the sense that for one is that when liquidity comes in, right, and some of these stocks we are not participating as institutional investors because we don't see liquidity over there, right? So, and if disinvest, these are good sectors. I'm not saying the sector outlook is good. So you want to be in those sectors. Within defense, for example, or railways, okay, there's a big investment plan, okay, which is in defense, there's more of indigenization, right? There's not big increase in the budget, but there's more sourcing from domestic side, okay, which is coming in. So we would like to, but again, when the liquidity event comes in, if there is a correction because of that, okay, the market participation will increase, and then it will be a much fairer market, right, for somebody to participate over here. So it's welcome. Supply of paper in this market is welcome, okay, if it comes right, because there's a huge demand which is there, right? So the problem what is happening in the market is there's a huge demand coming in from money which is coming into the market. The supply is not coming. Supply is coming in, by the way, now from a lot of people who are cashing out in the market. So if you look at in the last 1 year, there's a study which has been done. So a lot of promoters have sold, right? There are a lot of PE investors, okay, who had invested early, they are exiting the market. But we want supply to also come in from primary issuances, where the money goes into the company for future growth, right? So I think you will see more companies coming, raising capital for future growth, for future Capex, okay, which could be there. But I think supply, I think would be a welcome sign to broad base the market participant in those stocks. And to answer your second question about in terms of what's the outlook for the market from a next 5 to 10 year perspective, that's what your second question was. I think that's where I think I am more positive. I mean, despite the short-term overvaluation which could be there in the pockets, which is there, I think what we have seen is in the last, what you have aid to this government, it has laid a foundation, okay, for a much more sustainable long-term growth for India. right? All the reforms, heavy lifting, what we've done in the last 8 to 10 years, okay, across sectors, whether it is on the banking sector, whether it's on the manufacturing side, whether it's in terms of the tax reforms, right? So that will, I think, lay a foundation for India to grow at a much more sustainable pace for the next. And despite the challenges, I mean, global economy is not great, right? We don't have the tailwind of the global economy, what we had in the period of 2003, 2008, where the global economy is also doing well. Despite that, okay, we have been able to do this. And despite the COVID crisis, we haven't really spent out money, right? Doled out money. We have been very, very frugal and this thing. So we are in a sound wicket, and there are various pockets. The good thing about our economic market is that it's very well diversified. It's not one trick pony, one particular sector, right? We have various sectors, whether it is the banking sector, the IT sector, the pharma sector, right, which is there, the automobile sector, right? Now even the Capex, industrial Capex. I think all these sectors are looking good. The real estate sector also, which is again a large backbone, okay, outlook is there, fine. So given that, I think you will see corporate earnings growth at a steady pace. I think in the last 3 years, the corporate earnings growth has been very fast because we are coming from a lower base. I think that will probably normalize to around, say, 13-14%, slightly above your nominal GDP growth is what we think. And that's where I think the market will compound from here. There could be periods, okay, where there could be some period of time correction could happen. Okay, you could see ups and downs. But I'm very positive from a next 5 to 10 year perspective. I think if we have the kind of macro stability which we have currently, right, India, I mean, in which emerging market, okay, you will see the currency, if you look at the country's currency is the biggest barometer in terms of the stability, right? In the last couple of years, if you look at rupee volatility, has been the bottom decile compared to all currencies, right? Which shows the stability, okay, what the economy has. And also with interest rates coming down, okay, you will see with inflation, targeting inflation under control, a current account deficit, right? India would possibly, if the way which we are progressing and the way we are trying to substitute some of our imports and the way the service sector is going, services exports which are going, your current account deficit, we expect it to, currently it's expected to be around slightly around that percent, but you could also get into a current account surplus down the line, right? If you're able to maintain that tempo. We have seen a lot of GCCs, global, we have seen the big success of the IT outsourcing industry which has been there, but there's also another, which is a lot of global players are coming, the back offices into India through the KPIs and the outsourcing consultancy services and the GCCs as they call it, global competency centers. That again is a sector which is again growing very, very fast. So I think, and this is India's time, right? And the way the geopolitics are shaping up globally, I think India is also pretty well positioned over there. So way shift is moving from China. All these things factors, this is the time for India to really capitalize on that. And that's what the government is trying to really focus on, rather than focusing on trying to look at the short term and try to boost the economy through spending or to give freebies. That's not what you're doing it. So I think we are in good shape in that if you take that long-term view.
Just 2 bits on disinvestment. Traditionally, if you look at disinvestment has always been used as a revenue mobilization exercise. It has never been done to increase accountability or anything of that sort, right? So as things stand today, there is no real urgency to disinvest into any company. Obviously, in some companies, government stake is more than 75%. They will have to prune it down to 75%. And obviously, a lot of those companies, when they come to market, all the institutional investors, will invest only when they come at reasonable valuations, right? So if all of those disinvestments also will go through if they come at reasonable valuations, right? So per se, it is not either a big negative or positive.
Good evening, gentlemen. It has been a very good discussion, no doubt. I am so happy that you have thoroughly dissected the budget to a great extent, even though most of us here are more interested in this market. So my question is regarding the capital gain tax. Capital gain tax is see the other day, immediately after the budget, there was a press meet. What Mr. Finance Secretary, Mr. Sanjay Malhotra, what he said when he was asked, immediately our Finance Minister handed over the mic to Sanjay Malhotra. He was telling lower capital gain is to increase investment. And again he said, LTCG has gone up,
it has been rationalized. But when we work out whether it is short term or capital gain, I mean long term, where it has always, in both sectors it has gone up than last year. So I would like to have your thoughts, even though it has gone up. Why Finance Secretary has made such a comment, I don't know, even I did not understand. Then again, this tax liability is intra-day trading. Trading. There also, I think, how it will be calculated, whether it depends upon the equity holders' income, or will it be treated as a business income? Will you please? Your thoughts, please. Thank you. I am Mohandas, CP. Hope you got my point. Should I repeat? So, capital gain, all of us are concerned, sir. I tell you, we are most concerned about that because more than the last year, it has gone up like anything. Even the new calculation also, even though the ministry has said that they have rationalized, I don't think it has been rationalized. And that intra-trading, that how it is calculated, that also please explain. Thank you.
I didn't understand the second question, but clearly I think capital gains tax has gone up, okay, which is, I mean, everybody of us will get impacted. Okay, we have made good gains in the market, right, in the last few years, and to that extent. But again, the idea was that you don't want money to move into on a particular asset class, because that creates those bubbles, okay, which are there, right? And while equity markets is good because it channelizes money into any investments, right? When you invest money, when companies come and raise money, the capital markets are vibrant. Companies can raise money for investments for the future growth. So you need to have a vibrant capital markets. And again, so we have been used to a period where we have seen that capital gains tax was zero, right? Earlier we have gone to that regime. Earlier, prior to that, capital gains tax was much higher, which was there. So I think in this budget, I think when they mean by rationalization was that you're trying to, there were different capital gains tax for different asset classes which were there, right? Ranging from around 10% to 20% to the marginal tax rate. To that extent, I think they have rationalized that, right? So they have given only one capital gains tax at long-term capital, 12.5%, and there is a marginal tax rate for investing into the specified mutual funds, okay, where the debt component is more than 65% or so. So in that sense, they have clearly made it simpler in that sense. In some cases, you had indexation, right? For example, in real estate, it was the long-term capital gains tax was 20%, and there was an indexation benefit which was there. So that indexation benefit also they have taken away. Again, to simplify in that sense, their claim is that indexation, if you look at while they have taken away, they have brought down the tax rate from 20% to 12.5% long-term capital gains tax. So it should not really impact. However, it's not so easy. Okay, it depends, right? If you're, like for example, if you're in housing, if you're selling a house, for example, if your return there, okay, long-term return is somewhere near to the inflation rate, right? Then you are actually worse off, because earlier, because say housing or this thing, property is also a hedge against inflation in a way, right? When you look at it. So if your returns in the last whatever 10 or 15 years is just about 6-7%. Then you still have to pay tax. Earlier regime, because of indexation, right? Normally the indexation, okay, average would be around say 5.5-6% was the benefit you used to get. You hardly any tax you could pay. Only if you make a larger gain, right? The break-even is 10%. Above 10%, if your returns are there, then actually you are better off in this new regime, where your taxation rate goes down, but you forego the indexation benefit. So there is this plus or minus. But the idea was to really simplify. That's what the whole intention has been there. From a market perspective, as I said, again, while we all crib about it, finally, if you make returns, right, in the longer run, I think there should not be any reason why I think market will forget that. I think you will start factoring into your calculations, okay, when you're investing into a particular asset class also, you will look at what is the return I make post-tax, okay, what is the return, okay, I would make in that asset class, and then take that decision over there. So I would say that it should, again, market also, initially people thought that after this imposition, okay, you will see a big correction in the market. But whenever this has happened earlier also, I think we have seen a small blip, but after that, it has taken over into the expected return in that asset class is what drives investment in that asset class, period. I mean, You only pay taxes, as I said, only if you make returns. Right? If you don't make any returns, you don't pay any tax. As to the second part of the question, I was not too sure what it was.
See, let me flip the other way around. If the taxation would have reduced, would you invest more in equity markets? Not really, right? So we are essentially investing into equity market for growth, right? Taxation is a byproduct wherein if you make profits, you pay tax. So I think, as Mahesh rightly said, the objective is to simplify taxation, right? And it has worked both ways, right? Taxes reduce on one hand, taxes increase on the other hand. What they've tried is to simplify it. I think we should not read too much into it.
Sir, what is your take on this changes in buyback tax incidence? Now the budget has shifted the burden from the company to the individual investor. Further damage is done by treating the gains not as capital gain but as dividend. So, is it one of the unfriendly acts of the government as a series? First they reintroduced the capital gain tax and retained STT, securities trading tax. Now capital gain tax is further increased. Dividend, they got shifted from the company, dividend tax, to the individual. That means there is a thinking, I feel, that gains from the capital market is an easy money. It can be taxed at will, and investors will have the wherewithal to withstand it. What is your take, sir?
Yeah, I think what you actually said, in a way, it is true, because if you look at the recent economic survey clearly says that the financialization, the pace at which it's happening, especially at the retail level, has been way ahead of where considering our mid-income economy, considering our GDP, it is way ahead of that, right? And if you look at what SEBI is saying, what government is saying, I think they've made adequate noises that there is a froth and there is a lot of retail activity happening which is not as per their desires, right? So I think this is something which they have played their part to cool off the markets. As far as buyback thing is concerned, there was a clear arbitrage available which they plugged that actually. So nothing as such much on that.
So the buyback is actually, why would you say it is? Because see, what is buyback, right? The excess profit, either you pay by dividend or buyback, right? So it has to be, so if you are paying dividend, then at the hand of the investor, it was taxed at the marginal, after 10 lakhs, okay, or about 10 lakhs of dividend, it is taxed at the marginal rate. They're just trying to align that, right? So that's what the objective was about taking away this thing buyback, right? And really taxing it at the hand of the investor. That's the only objective over there, to really plug that loophole which was there. I would say that. Nothing more to look into it.
Shall I ask you? Yeah. The budget has been giving a lot of assurance as far as reassurance from the macroeconomic angle and the fundamentals of economy, etc. There is no doubt about it. But at the same time, for an average middle class or upper middle class, for the sale of property, of the indexation, the removal of the indexation from 2001 is definitely going to affect the people, especially in Kerala or in the small towns or wherever they are, from the sale of properties. And it is almost in an indirectly they are putting estate duty in an indirect way. This is how I look at it. So what is your comment on that? One more question. This is one question. It's a part of what my friend was talking. I am extending it further to this aspect on the property. Second is, there had been in the interim budget, they had given 11.11 lakhs crores was the amount what they have been given for the infrastructure. That is 10% increase was given. Earlier, the previous year, it was 28% or something. But this was in the interim budget. But after that, the elections came. After the elections, there had been a more, as the George Orwell says, some are equal, some are more equal. this kind of a situation is there for the infrastructure. Quite a lot of the money is going to Andhra Pradesh and Bihar. So actually, the share of infrastructure for the balance is to be divided between the rest of the states. So there also actually the infrastructure real benefit is coming down to many of the remaining states. What are your views on that?
Regarding the property sale indexation benefit.
Okay, you can take. I can also take. So tell me this thing: how much, like you have invested? You said in property, right? In your this thing. So what kind of return you would have made over there? Yeah. Right. So what kind of a gain you would have made over there? Just
It is substantial.
How much?
10 years.
Just give me a number.
It's very relative. You cannot say
Like
that.
15%, 20%, or 10%?
More than that.
More than that.
Yeah.
Then you are better off in this regime.
Is it that way? That's what I want to get it.
Yes,
confirmed.
I'll tell you, because you are, see, indexation, just give an example, right? So if your return, like for example in property, okay, was around say 7% only, right, compounded, right? With indexation benefit, okay, what would have happened was indexation would have given deduction. Normally, if you look at historically, it's around 6% is the kind of average inflation, 5.5% to 6%, which is there. So you would have paid only on that incremental 2%, right? Kind of for this thing, you would have paid tax. Whereas in the current regime, you will pay on that full 8%, okay, tax. Earlier the tax rate was 20%, now it is 12.5%. So you will be slightly worse off in that scenario. But if your returns are very large, like if you had made like more than 10% or 15% kind of a return, now, okay, if you really calculate from that 20% coming down to 12.5%, right, rate, you will actually better off, right? Your tax outgo would be much, much lower. So actually, if you have made a large gain, okay, on your property, then actually you are better off. But normally, if you look at in property, historically, if you look at why people have made large gain, but on a traditional basis, property has given around 7-8% kind of, around 8-9% kind of a return is what you would see, right? In that scenario, probably you might say that, okay, it is slightly adverse. But if your historical gain is very large, and if you do the calculation on in the earlier tax regime and now, I think you will be better off in the new one. I mean, if not, you want to...
Yes, I agree with him. But and another dimension to the whole thing is totally different from what we discussed just now. If there's a indexation, the removal of indexation makes property a less attractive asset class, that will be beneficial to the equities. Equity will be, relatively speaking, a better asset class for investment. So that will be better that way.
Anyways, if you actually sell your property and buy a new property, you are indifferent, huh? Right? So, yeah. And secondly, see, when government makes a tax change, it will be beneficial for some, it will not be for some. So, the other side will always cry. So, you can't make everybody happy. Infrastructure, what was the question?
You refer to the 11.11 lakh crores. That was the money allocated for Capex in the interim budget. And the same is retained in the final budget also. You can't expect a substantial increase from the interim budget. And also, there is a limit to the absorptive capacity of the economy also. Suppose you increase from 11 crores to 15 crores, well, it is difficult to spend the money. That absorptive capacity also is crucial.
That's a very valid, because I was just looking at some data, right? In the last few budgets, they have increased the allocation to railways, right? And some of the other ministries. But the execution is not happening to that pace. While the government has made the allocation, but the ability to execute those projects at the ground, and there are a lot of challenges which are there. So there's no point increasing that unless they have seen actually the allocation which have been done and actual execution at the ground level, there is a big lag, okay, which is there. So I think there are execution challenges also. You can't just keep on increasing that. And to that extent, I think they have kept it at a level, okay, which is fair. I think if they see that execution is picking up, even for the states also, what they're doing is that while there's an allocation to the states, okay, in this thing, okay, they don't give it straight away, right? They look at which state is executing well, right? both execution of the projects also and execution of reforms also. Like for example, in the power sector, right? What kind of they're looking at it whether you are not subsidizing power, okay, your losses are going up, right? Then accordingly, the money is allocated, okay, to the state. There is a broader kitty which is there. So I think execution is equally important, and if because in the earlier budgets, if you have seen, there has been large allocation which has happened in some of these sectors.
Abolition of angel tax and its impact on the future prospects of startups.
I think it is anyways a very good step. Honestly speaking, at that point in time, I think this was introduced in 2012.
Pranab Mukherjee.
Yeah, it was introduced in 2012, and at that point in time, they had an argument that some money laundering activity is happening in the wake of angel tax. But honestly speaking, as we just discussed, when they make such laws, the real startup industry actually end up suffering a lot, right? So when they actually took back this step, I think I would rate it as very reformative, because any tax which is based on presumptive basis is not good for either the citizens or the economy.
31%, very high rate.
Yeah, and that also was on a presumptive basis. So for example, now capital gain tax is being taxed on your profits, actual realized profits. Now this angel tax wasn't even on realized profit, it was based on assumption of the premium that you're getting over your fair value and things like that. Right? So I think this is a very, 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 very reformative approach, and I would actually summarize all these tax, and by the way, after many years, I've seen so many tax changes being done at one go in one budget. But having said that, if I were to summarize all of them in one line, I think the entire objective has been to simplify the taxation. With whatever plus and minus they have done, net impact, I have not calculated, but I don't think it would be more than, say, 10-20,000 crore, which is not a very big amount considering our, so what we spent, something like 50 lakh crores is our revenue and capital expenditure of the economy. Right, so from a base of 50 lakh crores, 10-20,000 crores, so none of this has been done from either revenue maximization or any other objective. It is just for simplification, I think.
One more question. Why there is no effort on the part of the government to widen the tax net? See, 2.2% of the country's population pays tax, income tax, compared to 60% in the US. Is that not a primary requirement for the growth of the country?
No, I think Nirmala Sitharaman, in her post-budget interview, she clearly said that we want to increase the tax net. Right? Now, unfortunate part of the country is that we have a democracy, and democracy, there is a large portion of farmers. There is a vote bank involved in that. You can't take such reformative steps, because otherwise then you will not be allowed to take a step anymore anytime. Right, so we'll have to live with democracy, right? That is a cost you pay for democracy. But all these formalization, digitalization of, so now when your Aadhaar card is linked to so many things, your land will be linked to your Aadhaar, and so many digitalization things that they're doing, all of this eventually will lead to formalization of economy, right? So tax net will increase, but everything will increase at India's speed, not at Chinese speed. And that's the honest truth, honestly.
The tax net is already wide. We have GST, where even products, goods of mass consumption are being taxed.
No, I'm talking about the income tax.
Income tax alone. Yeah. Well, the only way of widening income tax is to bring down the exemption limit, and that would be the wrong thing to do.
No, that is for the salaried class only, isn't it? What about the others who are not in the net? As you said, it is political.
Well, it is more than widening the income tax net. With better compliance, the tax collections are increasing. Now, large number of micro enterprises are paying tax, because formerly their revenue was not known. But today, even the wayside vendors, they are collecting revenue by way of money, by way of Google Pay, Paytm, etc. And that enables them also, that is beneficial for them, because that enables them to get loans from the banks, because the banks know what is their volume of business. So they are paying tax also, because everything is becoming transparent. So our
government has taken a lot of steps. So for example, in your income tax return, your capital gains is a pre-filled form. right? With a fingerprint, now you can get a SIM card, right? Now land records will eventually, slowly will get connected to your wealth and your income and everything, right? So all of this, through this pre-demonetization, they opened bank account for the entire country. So all of this thing will happen, but these are, multi-decade projects in India. This is not a overnight project, honestly.
Can I ask a question? The gentleman there said, why don't we broaden the tax base? Your spending comes out of your income. So if there is a tax on your spending, won't everybody in India be paying tax, income tax? I'm not talking of GST, I'm talking of income tax. So I earn income, I spend it. When I spend it, they collect a small amount of tax on that spending. So the whole population of India would be paying tax on the income that they spend. What is your opinion about that?
See, Indians are very smart. If you tax like that, then you will actually promote cash economy.
No.
We had a similar tax, expenditure tax, which the government of India adopted, I think it was in the 1960s, 64 or 65, on the recommendations of Nicholas Kaldor, who was more, left-oriented in his political and economic thinking. But then the total tax collections out of that was lower than the money spent on collecting that. Same was true of estate duty also, and that's why estate duty also was withdrawn by VP Singh in 1985 budget. Certain budgets, certain tax ideas would look very attractive in theory, but in practice it has just the opposite effect.
Okay, in that context, I want to ask another question. It is an endeavor of the government to curb black money. Now, the gentleman that said about selling properties, nobody in Kerala invests money in property just for trading. It is all ancestral properties or whatever it is. So now if you bring about this rationalization of capital gains tax, definitely if you look at an ancestral property, the tax liability will be much more. Don't you think that would encourage black money? Once again getting back into the rut of black money?
So a lot of these ancestral property will be pre-2001, right?
Pardon me?
A lot of this ancestral property will be pre-2001.
Yeah, right? But you can revalue it as 2001 and again index it.
All right. So the question here arises, the same calculation that Mahesh did. What you should look at is the indexation from 2001 to 2024.
So exactly, nobody sells property or looks at it like an investment. So if you say that your investment is more than, our return is more than 10% or 15%, which is less than the indexation increase, then you're actually paying more. That is not the reasoning. The reasoning is that I'm selling my property and I'm going to pay much more tax under the new regime, under the new proposal. Nobody looks at buying land, very few, maybe there are few traders in land. But very few don't buy land and then sell it with waiting for 3 years, 4 years, and then sell it. Hardly any. The general population sells land which they own or inherited, and there the incidence of tax is going to be so much higher. And this is a regressive tax, and I think going back to bringing back the curb or the malady of black money. People are slowly getting over it, but now this is a very, very regressive step. What is your opinion? You can't change the law, but what do you feel?
No, I don't think it will encourage black money by any standard, because your property will be registered, and more as registration of records happen. I think government has got enough mechanism in place eventually, not maybe now, but eventually to figure out what is the fair value of the property. I don't know about Kerala, but in Bombay, if a property is worth 2 crores and you transact at 1 crore, you are safely inviting income tax guys at your office.
Yeah, we have notified values here. You cannot sell below that, or you cannot register below that.
So that's what I'm saying. I don't know about Kerala, but in Bombay, at 90% of the places, notified value is roughly closer to market value.
So, in the interest of time, what I believe, the panel is going to be around. I believe there are a few more questions, especially around taxation. So it makes for a good conversation over dinner as well. Thank you so much for such an encouraging participation. Thanks a ton, panelist, and thank you guys for a very patient hearing. Thank you so much.
Thank you, gentlemen. And with that, we come to the end of this session on post-budget analysis and way forward. Please bear with us for a few minutes until we clear out the stage, and then we'll move on to the next session. Thank you. I'd like to invite Mr. Rahul Roy Chowdhury, CEO of Private Wealth Services, to address the gathering.